Hey everyone, me Kevin here. Let's be blunt. The Bears keep delaying their recession prediction because they're waiting for Jerome Powell's pressure on the economy to actually pressure earnings, leading to an earnings recession and potentially even GDP crush. That's what is keeping Bears relatively unallocated to stocks. And even though we've seen sentiment shift in tech, we haven't actually seen investor positioning from cash and from underweight positions go into tech and mass yet. So really, this rally that we've had over the last 3-4 months, keep it quiet, okay, it is barely a sign that investors have positioned from cash to TINA. Remember the days of TINA? That's when you wanted to sell. When everybody in November of 2021 is like, there is no alternative, all in on stocks. But right now there is an alternative. You're getting paid 5% on 2-year treasuries. And that hasn't really changed since November, which is remarkable. There have been some periods where it's gone down a little bit, but surprisingly, yields are staying hot. They're also surprisingly not crushing the economy. We look at the massive beat this morning that we had from durables and durables X autos, the massive beats in capital goods orderings, suggesting the economy is actually doing just fine. So what is the leftover bear argument, and what is this new data that the Federal Reserve is probably using, in addition to 5-year break-even inflation expectations, to determine to what extent they should act? Well, first, we know the Federal Reserve wants the 5-year break-even stable and trending down. It's somewhat stopped trending down in the last 3 months, which isn't great. We've also seen, as of a couple weeks ago, Jerome Powell sound a bit more hawkish, especially in conjunction with this summary of economic projections, which is a sign they're either frustrated by the stagnating of inflation expectations, or what I'm about to show you, some economic research directly from the Federal Reserve Board, or a combination of both of these. I expect it's likely to be a combination of both. 5-year break-even inflation expectations not trending down as much as they should right now. They're stagnating a bit. And also, what this particular economic research shows us. Now, it starts off really boring, and you think, oh my gosh, Kevin, why are we reading this? Let me just get to the juicy stuff for you and save you lots of time, because that's what I like to do with course members as well. Remember, coupon expires a Friday. That is after PCE morning, big inflation catalyst, so make sure you mark that on your calendar. And then we'll have a big lecture release set this weekend, refreshing a lot of content with new content and adding a lot of value to the stocks and psychology, the zero to millionaire real estate investing, even more value to the AI and productivity course, bringing a lot. So stay tuned and buckle up for that. So what do we have here? Supply and, and if you lock in your price now, you get the best price going forward, price match guaranteed. That's a way of rewarding existing course members. So what do we have here? Supply and demand driven contributions, year over year headline PCE. Let's go to core. Here it is, core, year over year. So when we're comparing headline year over year, this isn't going month to month, but looking at this all the way through April of 2023, we have a problem. Yes, Houston, we have a problem. The problem is demand-driven inflation is actually starting to slightly trend up. Let me show you that by taking a screenshot of it, and then we can play with an annotation here. Ready for this? Watch this. So let's use a nice red, juicy, thick color here. And look at this trend on demand-driven inflation. This is not good. And this has been consistent since about April of 2021. So for about the last 2 years, we have seen demand drive inflation. What's remarkable is the Federal Reserve started raising rates here. And they raised rates 500 basis points. They've not changed this trajectory of demand-driven inflation. Now, what's scary is demand-driven inflation alone is already at the 2% target, and that's just for core. That doesn't even leave any room for non-core, like your energy inflation. That's not good. So then you have inflation driven by either supply or demand items, and then you have supply-driven inflation. Now, the neat thing about this tool is if we zoom in, we can actually see here how much is contributed by supply. And we can see it really depends on where you're looking at it. Supply chains really were contributing around 2.3, 2.5, 2.6% here at the beginning of 2022. and that's declined and stabilized at about 1.5. But once again, it's not compressing. It's really not compressing. It's staying stable. 1.6, 1.47, 1.5, 1.51, 1.54. While at the same time, this demand-driven inflation is somewhat on a minor uptrend. If we zoom into just here, I would call it a minor uptrend. Hopefully it's flat. But the problem is if we end up flat, what do we end up with total core inflation? About 4.6, 4.7%. It's not enough. That is, the Fed isn't really hitting what they're trying to hit yet. I mean, in theory, after raising rates 500 basis points, demand should be slowing in terms of its contribution to inflation, but it's rising. It's doing the opposite. Now, we're seeing the overall inflation rate fall, and a lot of that is because of year-over-year base effects. Problem is, we're still going, and so while the numbers are coming down, right, we're coming off like 9%, right, we're going down to under 5%, that's fantastic. But the problem is, what happens when in the second half we potentially get stuck at these levels? Well, what we need is an economy that's resilient. So far, we're getting an economy that's resilient. People are still able to get jobs. Anytime there's a layoff, those people seem to manage to get jobs again. Job openings aren't really plummeting, suggesting there is still some redistributing of jobs that's happening. And again, yeah, changes in the participation rate could end up changing the unemployment rate. But even if that ticks up slightly and the unemployment, actual nominal level of people unemployed doesn't change much, then it doesn't matter so much. And the economy, in many regards, is showing signs of strength. Now, I'm not suggesting this is like a booming economy. I get those comments where people are like, oh, Kevin, you think it's absolutely booming? No, I think we've had our sort of slowdown in 2022, and we're probably, doing this sort of slow U-shaped recovery. The data we're getting is consistent with an economy that has slowed down, but that is already starting to reaccelerate. So the leftover bear argument then is not actually recession and earnings recession. It's actually, okay, well, what's J. Powell going to do next? Is J. Powell actually going to have to rug pull us, or are they finally going to accept fate? That's what I hope that they will do. That is the flexible inflation target policy of saying, look, if the economy is doing well and we're at 500 basis points of rates, 5% or 5.25 or whatever they end up at, we're just going to kind of chill out here until inflation actually comes down. And we'll just patiently wait. Remember how long it took inflation to go away in 1982? Probably not. But really, to get to 2%, it took about 40 years. Okay, maybe not totally 40 years. It was more like 20 years. But we've just had the highest inflation in 40 years. That's because we never hit higher levels. But realistically, it took about 20 years to get down to about 2%. And you've had fluctuations around the number after about 20 years. That's a long time. That's like a savings and loan crisis in that to help bring you down. That's a 2000s dot-com bubble in that to bring inflation down to 2%. So it did take quite a bit of time, which would definitely throw cold water on the idea that inflation ends up proving to be transitory. Certainly if you look at that chart I just showed you, that Federal Reserve PCE data, it doesn't look like it's going to be transitory. The question then is just, is the Fed going to remain patient? Now, Jerome Powell speaks tomorrow, so we'll see how aggressive he gets. I think the Fed can afford to remain patient as long as inflation break-evens are low. But once those disanchor, it's a problem. So they're really stuck between a rock and a hard place. But personally, what do I think about all of this? Well, personally, I think that as long as the economy is recovering and at least doing relatively strong compared to a recession, that is not indicating that we're definitely in the midst of a recession, then I'm okay investing in great companies and looking for great value, looking for price to earnings growth levels of under ideally 2 to really add. I prefer around 1.6. If I can get a company with a peg at around 1, I'm interested. You have to be careful. Sometimes there's a red flag or a sign that the industry is really suffering. Look at Canadian Solar, super low peg. I don't have any exposure to it, but that whole energy sector is just getting smashed. Enphase is like a 1.2. PayPal is around a 1. It's under 1. Ubiquity is under 1. These are companies with potential growth ahead of them at great valuations. So anyway, all of that aside, my thinking is as long as we keep getting data that says we're going to keep delaying the recession, I'm willing to be patient on these rates. Now, eventually, that is going to crush whom? Well, mostly commercial real estate in the refinancing disasters coming up. But beyond that, Is it really so terrible that companies have a slightly higher interest expense? Not if they're still able to make more money and their margins are growing. They just absorb the higher interest expense and you keep going. So kind of fascinating. Some folks are calling the recession canceled. Of course, the inverted yield curve would highly disagree with that. But today was a good news day. And I think that's why the stock market went green. It's finally actually starting to price in lower odds of a recession. It's not by a lot, but we actually saw the odds of recession from the Bloomberg tracker, the consensus tracker, go from 65 to 64. And it's always kind of been trending up. And the fact that it's now trending down is a pretty neat inflection point. I know it's like super minor and probably doesn't make a difference, but it's because everybody keeps delaying their recession forecast. Because every time they would say the recession's coming, we're looking around going, what recession? Again, that's not to say prices aren't high and the economy isn't weakened. Certainly is. Without a doubt is. But these are some of the considerations I'm looking at. And when Jerome Powell speaks tomorrow, I'll be covering it live. His discussion with Sarah Eisen begins first thing in the morning after the bell. And I'm going to be looking for specifically what is Jerome Powell's take on the patience they have available for getting inflation down. Because otherwise the economy could just keep going as long as J. Powell doesn't ruin it. The good news is 2022, starting in March and a year out, we went up about 500 bips. Now we're talking about maybe another 25 or 50. Like marginally, who cares? That's like 5 or 10% of the pain that we got previously. Big deal. Anyway, thanks so much for watching. Check out the programs on Building Your Wealth link down below. We'll see you in the next one. Goodbye.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by